Hello traders, in this video we're going to be looking at how to identify swing structure and how to use swing structure to identify the true higher time frame order flow. Now a lot of traders do use higher time frame order flow and they will look at the 4-hour chart to determine what bias they're going to trade on lower time frames such as a 5-minute or 15-minute chart. But these time frames are very far from each other, and you'll find that price may actually be, or the market may actually be moving counter trends to the 4-hour order flow on lower time frames, so in the short to medium term. So by using the higher time frame such as the 4-hour for your bias, you're actually going to miss out on opportunities, and a lot of the time trades counter to the actual true higher time frame order flow, which is going to eat into your strike rate and it's going to eat into your profits as well. So without any further ado, let's begin. I did want to get my face in this video, guys, just so you can see what I look like. I'm just a normal trader like you. So let's get straight into it. I hope you guys enjoy. So guys, we're going to start with a few diagrams before we do jump into some price action. So if I just start drawing a standard bullish order flow, so we can see that price is trending upwards. And then we get a break of structure to the downside. If we just draw we'll just put that in white for now. So we've had major highs being broken. So no major lows being broken, only major highs. So this confirms to us that we are in a bullish order flow. And then we get a break of structure to the downside. I know a lot of people do call this a chart or a change of character. It's not actually the case. You have read Wyckoff, but we won't get into that now. You get a break of structure to the downside, and then you get price. Well, sorry, once you've got this break of structure to the downside, although these are major highs on this time frame, this will actually be a major high on a higher time frame. So once you get this first break of structure, this is now confirmed as a higher, or a major swing high or a swing high. So we're going to actually draw that in green. And then what you'll find is price will start trending downwards. And obviously this would have been the swing low. What you'll find, guys, is if the higher time frame order flow is bullish, this swing low won't get broken. This swing high will get broken. So you'll find that this will be protected and price will break out of structure again. Order flow will reverse on the current time frame and price will break upwards. And then the same will happen again to the downside and like so. So once you get this break of structure by here, once this swing high is broken, and then you get a break of structure to the downside, this becomes the new swing high, and you can actually follow price backwards, find the last break of structure then, and this will be the swing low. And you'll know that this is now protected. So price is likely to continue moving upwards on a higher time frame, and this allows you to catch a high risk, high rewarding trades, just because you'll find that price will actually come back into these extreme demand zones that have actually originated at the start of the current trend and the end of the last trend. Only the banks have the ability, the power, the money to reverse order flow. The forex market moves trillions, guys. Only the banks have that sort of money. So their orders are going to be sitting here waiting to be fulfilled. They've still got orders here. They create the imbalance in price. That's what causes the break of structure, and then price will be manipulated back to this point through use of inducement and manipulation. And the rest of their orders will get fulfilled, and another imbalance will start causing price to break the last swing high. So this is how I trade, guys. So if you actually were looking at a higher time frame, this would simply look like this on your chart. We'll just leave that off for now. The reason why we do this, guys, is because this is showing you the true higher time frame order flow, because volume is going to change at different times of the day. Swings are going to happen, or larger swings are going to happen at different time scales. So you're going to have a large swing that happens on the 15-minute chart or an hourly chart. And by using two specific time frames, such as the 15-minute in line with the 4-hour, your data is going to be skewed. And there are going to be times where you're going to be trading counter trends to the true swings that are being presented by the market. And you're going to miss out on opportunities, or even have your profits taken away because you've been trading counter trend. So if we go now on to the actual chart of the the US 30, we'll just go by here, for example. So we can see, let me just get into here. So we can see major structure has been broken to the upside. No lower lows are being made, only lower highs. And then by here, we go follow price back. You get this first break of structure to the upside. So this now becomes the last swing high. And then we follow price back. We can see that lower lows are being made, no lower highs. Then if we follow price back, we can see that there was a break of structure to the upside, confirming this as the swing low. Let me just move this down. So that is now the swing low. Obviously, price has been moving upwards, so we know that the swing high is likely to break, as the order flow on a higher time frame is bullish. And you can see by here, the swing high has been broken. If we follow price back, you can see that there was a break of structure to the upside, break of structure to the downside. This becomes the swing high, and you follow price back, and we can see there was breaks of structure to the downside, break of structure to the upside. This becomes the last swing low. So we know that that low is protected, and obviously price is going to continue moving upwards there on a higher time frame. And then what do we get, guys? So you've got, once we do get to this point in the market where the momentum is slowing, obviously you've had the break of structures to the downside there, and all we need to do once we've drawn our swing high, which will be by here, we just actually reverse price. So right now, guys, we are expecting order flow to continue upwards, but we follow price back. You've got this swing low that's been presented. How do I know this? Because you've got this break of structure to the downside, and then a break of structure to the upside. So that's the last swing low. Until this breaks, guys, you don't look for trades, because on a higher time frame, currently the expectational order flow, the expectation is for price to break upwards. Once you get the breakdown, like so, and then you get a break of structure to the upside. That is the last swing low. And obviously this is the first swing low now. So the first lower swing low, in fact, which means that the swing structure is now changed. The swing flow is now changed to bearish. We can follow the price back, and we go back to where the last swing was. So this is substructure by here, but you can see that there was a break by here to the upside after breaks to the downside. So this now becomes the last swing high. And obviously this is now an extreme demand zone. You can see that there's imbalance that's being presented by here. If we turn our imbalance and volume indicator on, we can actually see that there's fairly decent volume by here. The volume beforehand, although it is mitigated, was much lower. So we can safely assume, guys, that price is actually going to reject this supply zone. So we continue upwards. The swing low has been broken. We will wait for a break of structure to the upside, like so. We follow price back. You add structure breaks to the upside, structure breaks to the downside. Now this actually is now a extreme demand zone. So this, let me just delete that. This actually now becomes the new extreme demand zone, a supply zone. So this is how I trade. Very easy, and honestly, one of the, I wouldn't say one of my biggest guarded secrets, because I'm sure there are other people trading like this, but I mean, this is the best way to trade, personally, in my opinion, just because you're not overcomplicating things by looking at all these different time frames. You're doing everything on one time frame, guys. Actually, follow price back. We can see that obviously this was the swing. Yes, we had a break of structure to the upside by here. My bad. So that was the swing low. And then break of structure to the downside. So that is now the swing high. And it breaks again. Obviously, there was no break of structure to the upside, but here you can actually see, if you go onto a higher time frame, that there was no counter trend candles, which means there's no major structure that's been made. So personally, for me, the way in my strategy, we don't actually utilize this as swing structure. In fact, you can actually see, and this is why it's good to use liquidity, guys, because it's good to actually use it in line with this, just to confirm, because sometimes there is always going to be a little bit of discretion. For example, are you counting this as major structure? Obviously you get that wick by here, but there's no counter candle pullbacks, guys. So there's none of this going on. It is just a straight line going down. There's no counter trend candles there, personally. So I'm still keeping my swing high there, and you've got this liquidity built up for that. So you could even have another zone now drawn by here. I personally didn't have another zone. I was very happy with the trade that I caught by here. For example, I actually captured, I think it was around, I'm not too sure if I did have it. Yeah, I had about 11.5 from that trade, I believe. But you could have, obviously you're trading with the higher time frame order flow, so this does allow you to be a bit more lean with profits. I personally like to take my profits and run once I do get over 10R, but obviously this is down to you and your own back testing at the end of the day. So this now is still the swing high. Like I said, no major structure broken to the upside by here, so we leave our swing high by here, and we know that no matter what price does in this, if it sweeps through this liquidity before dropping, we know that it's likely to continue downwards on a higher time frame perspective. And if it does decide to break up from this, what do we do, guys? We simply start looking for longs at that point. So we can play price now, confident that price is either going to reject this and continue moving downwards, or it's going to break through this and continue upwards. So we've got a rejection by here, so you could have looked to get involved there, and obviously right now you've got a break of structure to the downside. You know now that this is going to be the next swing high if this breaks. Coming into low hours, guys, you can see the volume. So this is where the setups really happen now, is actually at this point in the market where the exchange opens. This is obviously the US 30. We can see, guys, we actually draw some more liquidity by here. You can see there's liquidity built up. Obviously it was swept by there, but it's swept, just creating more liquidity. And you've now got these double tops, which I didn't actually spot there. So liquidity can go amiss quite easily. You do have to stay on top of liquidity, but you can see that you've got these equal highs by here, creating liquidity, and by here. Now this doesn't mean that price is bullish. It can actually just mean that it's going to just sweep the liquidity that's been built up before moving lower, because the banking objectives may still be to move price downwards. We can see that there has actually been a liquidity sweep by here, eating into this liquidity that's been built up, but price has still to continue moving downwards quite impulsively as well. So you can see that there would have been liquidity built up by here, liquidity built up by here, liquidity built up by here. And this impulsive movement happens, guys, just because you've got all this liquidity built up. It's all higher highs and higher lows. So when there's higher lows, it means that the liquidity isn't getting swept under these zones. So then it'll induce a massive sweep of liquidity, guys. And we break the swing low there. And just do a couple more. So there was, like earlier, I did say that there wasn't a counter-trend candle pullback by here, so no major structure to be broken. We can actually see that there is a counter-trend candle pullback, or counter-trend pullback. And we get our break of structure to the upside. So this, which is the lowest wick, becomes the swing low. We follow price back. We can see prices breaking upwards, breaks to the downside, and this is the swing high. So we know that that is now protected. We can actually look to get involved in the supply zone that's been formed. Now you've got this this giant wick by here, guys. If we come down onto the 2-minute chart, for example, because if you were simply just using the last counter trend candle by here, you've got this small doji by here, which is very likely to contain the original orders from the banks that caused the imbalance. But I personally like to draw my order blocks on the wicks, because we know that there is likely a counter trend candle within this region which likely caused the imbalance. So if we go down to the 3-minute chart, we can refine that again. We can actually start looking at new data. We can actually see that this is one large counter trend candle. So we're actually going to just draw our order from here. Now I don't know if this is going to reject, guys. It may well not, but it might not even reach it. I wasn't actually looking at what the US 30 did after our trade. It might even come into, yeah, I don't think, yeah, so we're not actually at this point in the market yet. But I would be looking for an entry up here now, guys. But that's just on with current higher time frame order flow. If we go now onto the hourly, we can actually see, which I was discussing with some of my members earlier. You've obviously got this liquidity built up by here, but you've also got liquidity built up by here. We did get that sweep like we saw earlier, but this might be one part of one larger schematic. So if we get that swing structure break to the upside by here, we'll know that it is a reversal of higher time frame order flow, and we can start looking for long opportunities, guys. But if we actually do move price across, we can see that actually we'll have to sweep into liquidity to actually break into this this zone by here already. So this may still be well protected. You still have got a massive amount of liquidity, so it may even be wise to place your orders above this zone, or what you can do is wait for something like this price to penetrate your area, reverse back, retrace back down below your order block, and then you get into a fresh supply zone that's been created after the break of structure to the downside. That is it from me, guys. I just wanted to give you a bit more of an insight on how I take my trades. We are still using higher time frame order flow, but we're not looking at all those higher time frames, which can complicate things. We're also able to use order blocks that are already pre-refined from those major highs and lows on higher time frames. So it's taken out a lot of the work by using it this way, and you're not missing out on swings. Like I said, swings are happening on every time frame. By trying to match the 15-minute chart with the 4-hour chart, you're going to miss out on so many swings. You're going to be trading counter trend a lot of the time, and you're going to miss out on opportunities, which is going to eat into your strike rate and overall profitability. I'm not saying it can't be done, and you can be profitable in many different ways in Forex as long as you've back tested. A lot of traders don't actually back test these charts together, such as the 4 and the 15-minute chart. They're just copying other traders who they've seen there. This method that I use is easily back testable. You could do this yourself on any time frame. It doesn't have to be the 5-minute chart like I use. You can do it on the hourly chart, the 15-minute, any market. This is going to work on because it utilizes core market mechanics. If you did like the video and if you learned anything, guys, it would be a massive help if you did like and subscribe. It does massively boost me in YouTube's algorithm, and you can obviously see any new video that I put out. I will catch you guys in the next video. Hope you have a lovely trading week. Peace out.